Hi everyone, Joe Gentili from Left Tail Risk Advisors. So I was thinking today, for a lot of you, you may not know, I'm also a practicing attorney, and I've been a practicing attorney for over 20 years. Spent most of that time in complex litigation, and a significant chunk of that litigating life insurance issues. So I've spent thousands of hours in the weeds looking at how life insurance policies go wrong and how they fail, because that was just part of my job in representing policyholders. And I was thinking, if I were to talk to people about like one single thing to avoid as many of those failures as I've seen as possible, what would that be? And I think it would be to understand life insurance illustrations, and particularly the fact that these things are used in a way to mislead folks a lot, and just where that point of misleading really originates. I have a colleague that I really respect, and he coined a phrase for this that I think is a really good description. He calls this, what I'm about to describe, the illustration beauty contest. And then, his little parenthetical for it is it's the attractive impossibility versus the less attractive probability. It's very important to understand this. So if you're going to buy life insurance, and let's say you're buying a permanent life insurance policy, um, and it's a competitive situation, you're looking at multiple policies. You may get one policy that shows $1 million death benefit and a $12 million premium. And I say premium in air quotes. And then next to that, you're going to get shown another policy that is $1 million death benefit and a $6,000 premium in air quotes. There are no shortage of life insurance companies, life insurance agents that will try to give people the misunderstanding that the policy that has the $6,000 premium is cheaper and a better value than the policy that has the $12,000 premium. And that's simply false. Those companies and those agents, they understand that most people look at a policy, and they see one has this for the same death benefit, one's asking for half of the amount of money of the other, therefore it's a better deal. And it's understandable that people would think that way, because in almost every other area of life and most other area of insurance, it does work that way. But for universal life insurance, that's straight universal life insurance, index universal life insurance, variable universal life insurance, premium is not the same thing as the cost of insurance. That $6,000 that they're asking you to put in, that is based off of assumptions for how the policy is going to perform over time. And all too frequently, those assumptions that agents will plug in with the carrier's blessing will be very aggressive and very optimistic, and in some cases, I would say impossible to meet. And that's in order to make this policy look like a much better value than it is. But in reality, I think there's a good rule of thumb that the better a policy illustrates, the less reliable it is. The more likely it is to lapse during your lifetime if you fund it the way that they're telling you to fund it. This is not true with whole life insurance, by the way. With whole life insurance, one of the attractive features of whole life insurance is that the the premium is guaranteed. So as long as you pay the premium in the policy stays in force. That's true in whole life insurance. It's very simple. It's a very valuable um, feature of that particular product structure. Not true on the universal life insurance side. It's a suggested amount to fund, and the more rosy the assumptions that you use on how this policy is going to perform, and the less amount of money that you fund it with, the more likely it is that that policy will end up underfunded and therefore lapse during your lifetime, which is a disaster. And that's the disaster situation that I've worked with a lot of clients when they get into. And unfortunately for them, this misunderstanding that the carriers and some agents encourage doesn't become apparent until many, many years after the person has bought the policy and has funded the policy. And frankly, sometimes it's too late to do anything about it. Most people, when they buy life insurance, they are looking for um, a reliable way to make sure that there's a certain amount of money available to their beneficiaries and their loved ones when they pass away. And by succumbing to this beauty contest, what's happening is there's a lot of risk being put into that. So it's no longer reliable because if you're underfunding the policy, according to some rosy projections that are not only are they not guaranteed to happen, but they're very unlikely to happen, you, the policy owner, bear the risk that either the policy is going to lapse due to underfunding or you're going to have to kick in a lot more money to keep that policy in force. So if there's one thing I'd really like to help people understand on the outset is that you need to understand what I'm saying on this point that in the permanent life insurance world, if you're in the universal life side of the spectrum, premium is not the same thing as cost of insurance. Just because you pay the premium that they're laying out in an illustration does not mean the policy will stay in force for life. With whole life insurance, it does, but with universal life insurance, it does not. And so, very important to keep that in mind. Very important to work with life insurance professionals that also understand this and that are ethical and you can trust what they say. So, I've seen this play out too many times as a lawyer litigating these cases. So I know this happens a lot. So just be very careful on this point. If you're careful on this point and you understand this, you're a long way to having a successful experience buying a life insurance policy and keeping it in force. So, any questions on this topic, please feel free to reach out. And if this was helpful, I encourage you to like and subscribe for future videos. Thanks.